1.5 billion vehicles on the road today that all have something in common: the essential intelligence of S&P Global Mobility. We provide invaluable information across the entire value chain, enabling vehicle manufacturers, suppliers, dealers, and consumers to make decisions with conviction. Our proprietary data is used to set pricing, plan future production, determine demand, and accurately predict make and model preferences. We give consumers powerful and intuitive tools to help them buy vehicles, understand what they're worth, schedule service, and decide when to sell. And as the industry undergoes its most profound shift since mass production, our data and expertise provide forward-looking insights to improve sustainability and advance innovations such as electrification, autonomous driving, and digital retail. The next chapter in automotive history is being written. Pioneering decisions are being made using the essential intelligence of S&P Global Mobility.
Good morning, good evening, good afternoon, wherever you are. Welcome to our 2022 Automotive Solutions webinar series. Today, we will give you an update of the European medium and heavy commercial vehicle forecast. My name is Christiane Stein, and I will be your host today. And in this role, let me walk you through a couple of housekeeping items before I introduce you to my colleagues. You can activate live captions in the live captioning widget. Click on Show Captions and then click on Languages and select your preferred language. And the captions will appear in the box. The live captioning window can be moved and expanded to fit on your screen wherever you want it to be. We encourage you to send in questions during the webinar through the Q&A box. We will have 2 Q&A sessions during this webcast, one after the economics part and one after the vehicle part at the end. Should we not be able to cover your question during this webcast, we will answer your question by email. We would also appreciate if you could give this webinar a rating to support us improving these events and also to cater to your needs in the future. The presentation slides can be downloaded from the resource list as well as other resources. Should that window not be open already on your screen, you can find it by clicking on the document symbol at the bottom of the screen. Before we move on to the content, a couple of words on the company. IHS Markit is now a part of S&P Global. And this is a new beginning, and you can expect the same great content from us as usual. We combine the right data, connected technologies, and our experts to deliver the intelligence needed for your decision making. S&P Global provides you with data, analysis, and insights across its 6 divisions: market intelligence, ratings, commodity insights, mobility, S&P Dow Jones indices, and engineering solutions. The automotive practice is now a part of S&P Global. Here, we provide invaluable insights derived from unmatched automotive data, enabling our customers to anticipate change and make decisions with conviction. Our expertise helps them to optimize their businesses, reach the right consumers, and shape the future of mobility and transportation. S&P Global Mobility provides you with essential intelligence on strategy, planning, and products, on new vehicle sales and marketing, on used vehicle sales and service. So reach out to us if you want to know more about our products. In today's webcast, I'm joined by Kenneth Wadrad, our Chief European Economist, who will tell us more about the impact of the conflict in Ukraine on the European economy. Then I will present the impact that this has on the production outlook for trucks and buses. And my colleague Renata Rakauskania, the senior analyst in the Global Heavy Truck research team, will talk us through the changes on the demand side for Europe. And with that, Ken, the floor is yours.
Thank you, Christiana, and hello, everybody. It's my pleasure to join you today. My comments on the economic outlook will focus on three key aspects. First of all, how the Russia-Ukraine conflict is impacting on our forecasts, where the impacts are largest and why, and the key risks surrounding some of those forecasts. Let's start with the transmission channels through which the conflict can affect economic developments. These are numerous, and I've highlighted some of them here. This includes the obvious things, the impact on energy and other commodity prices, disruptions to supply, linkages through trade and financial flows, confidence effects, financial stress, and also monetary policy tightening related to one particular aspect of what's happened, which is further upward pressure on consumer price inflation rates. Now, of course, it's important to stress that these spillovers do not impact on countries and regions uniformly. Europe's trade and financial linkages with Russia, for example, are much more extensive than those in the US. The US also has the advantage of being a large-scale producer of energy, an issue we'll come to shortly. And of course, within the regions, the country-specific sensitivities to what's happening in Russia and Ukraine and spillovers, they also vary. Now, we have the advantage in global market intelligence of using our global link model, a macroeconomic model, which allows us to consistently calibrate the economic effects that I was talking about in the prior slide across regions, countries, and sectors. And we did that late in February after Russia's invasion of Ukraine, and we updated our forecasts in the first half of March to reflect all of those transmission channels. Now, the impact on our real GDP growth forecasts is highlighted in this slide. The key takeaways include a substantial downward revision to our 2022 growth forecast, global growth forecast of almost a percentage point. That now is just over 3% compared to just over 4% previously. We've made a much larger downward revision to our forecasts for Europe, a decrease of well over a percentage point, with growth rates in the EU and the Eurozone now forecasted around 2.5% this year. We made a less pronounced downward revision to our North American growth forecast. That remains over 3%. That reflects a number of offsetting factors and a lesser sensitivity to those transmission channels. And the winner from this scenario is energy producing countries. And we've boosted our growth forecast for the Middle East and North Africa region to reflect that, both the impact on energy prices, but also on energy demand, given disruptions related to the conflict. Now, these forecasts are predicated on a wide range of different assumptions, which we highlight in this slide. Now, some of these assumptions are, of course, very fluid and highly uncertain. Thinking about what happens militarily with Russia and Ukraine, for example, we assume that the conflict will continue for several months. That will have spillover effects on trade channels. We also assume that it will have a persistent upward effect on a range of energy prices, though, of course, they can move around with a high degree of volatility. And in our next forecast update, which takes place on Friday this week, we'll incorporate a somewhat less elevated path for crude oil prices. Now, at the margin, that implies somewhat stronger global growth than in the previous table and somewhat lower inflation. But oil prices are not the only factor at play here, and particularly for European economies, the elevated level of gas prices and also potential risk to supply are very important. Now you'll see at the bottom, with regard to COVID-19, we're assuming here that new variants are less severe, that vaccination rates continue to increase, and effective treatments become more widely available across the globe, allowing economies to remain open. And that is a material change and an important influence on our forecasts as well. It seems that we're in the latter stages of the pandemic in terms of its economic impact. It doesn't mean the pandemic is over by any means, but given those changes, economies can stay more open than they did previously. So lots of different moving parts here. Now, in particular, I mentioned the sensitivity of Europe's economies to energy supply from Russia. Now, more than 20% of the EU's crude oil imports come from Russia, and more than 40% of its gas. Now, in our baseline forecasts, we assume that the energy shock mainly comes through the price channel, not via reduced supply. Reduced supply is a key additional source of potential downside risk to our growth estimates. Now, in Europe, as you're probably aware, there's an ongoing discussion about the potential introduction of an embargo on imports of Russian energy, initially focused on coal, potentially moving to oil, but also being discussed is gas. Now, as I said, in our baseline, we do not assume a prolonged disruption to energy supply through this channel, but that is something that we clearly need to monitor closely. It's a potential game changer for our forecasts, particularly in Europe, with gas accounting for around 20% of overall EU energy usage. Now, as I said, there are other factors which are also supportive for growth, improving COVID trends. We have excess household savings following the COVID pandemic that provides some cushion for households which are undergoing a severe cost of living squeeze. But if we see major disruptions to energy supply, then we think recessions would be inevitable, particularly for the most heavily dependent countries, including Germany and Italy in Europe, and also for particular sectors, the most energy intensive, including chemicals. Now, of course, it's not just energy prices that have been affected by the conflict in Ukraine. We've also seen increases in a range of other commodities. Agricultural prices, including wheat, have increased substantially, and also key items impacting on the auto industry have seen their prices rise substantially as well, as I'm sure you're all too aware. And combined with intensifying supply chain disruptions, partly related to what's happening in Ukraine, partly related to COVID trends in China and China's zero COVID policy, those commodity price increases are adding to already extensive inflation pressures globally. And they're creating two additional headwinds to growth. First, a huge squeeze on household purchasing power, which has very negative near-term implications for consumer demand. And secondly, a shift in global monetary policy, as central banks seek to keep inflation and inflation expectations in check. The next slide illustrates the dramatic changes to our inflation forecasts following the Russia-Ukraine conflict, again calibrated via our global link model, and again with Europe most impacted. So you'll see that the revisions on the right-hand column here to our consumer price inflation forecast for 2022. In Europe, they've increased by almost 3 percentage points. And the rates of increase in inflation, which we're now expecting on average for this year, are at the kind of levels we wouldn't have thought imaginable not that long ago. So UK inflation expected to average more than 8%, for example. Continental European inflation averaging around 7%, and some exceptionally high rates of inflation in some emerging markets, and of course in Russia for very specific reasons. Now, we haven't seen these kind of inflation rates for decades. In the Eurozone, for example, the March print showed a headline inflation rate of 7.5%, a record high, twice the previous peak back in 2008. It's even higher still in emerging Europe, where central banks are much further advanced in tightening their monetary policy, but by no means done. adding to already strong growth headwinds. And so here is a visual representation of where we see the biggest impact of this shock, particularly pronounced on emerging European growth rates to the downside and on emerging European inflation rates to the upside. But it also has material impacts on Western European economies and other regions around the globe as well. Now, this brings me to the next point. How will central banks respond to the challenge of soaring inflation, but at the same time, weaker growth prospects, which we see pretty much everywhere across the globe? Well, I think if we think about what central banks are indicating, the answer is pretty clear. They're telling us that they're going to have to tighten their monetary policy more rapidly than previously anticipated in order to keep inflation expectations well anchored. Now, inflation expectations are pivotal because we have these ebbs and flows of inflation rates, but as long as inflation expectations remain well anchored, then spillover effects through to wage developments are typically relatively modest. The risk is if inflation expectations become unmoored, then that would lead to a wage price spiral. And that's something which central banks are now prioritizing, the avoidance of that kind of wage price spiral. Now, there's no way to avoid this problem, because if central banks stick with their accommodation and inflation expectations do get out of control, then they'll only have to tighten more later on. And so to avoid short-term hindrances to output, they may end up with even larger output losses in the long run. I think there's also another point to emphasize, which is that raising growth can no longer depend on policy stimulus, either fiscal or monetary. It can only be achieved through sustainably supply-side orientated policies that raise productivity growth. But in many countries around the world, including many in Europe, the political conditions and the policy frameworks required to make those productivity gains are very difficult to achieve. So the economic outlook beyond the immediate shockwave of the Russia-Ukraine conflict is becoming more challenging. Now, as the next slide shows, we already saw a marked increase in our measure of global financial stress following Russia's invasion. And there's an increased risk, we think, of more volatile financial markets as central banks continue to withdraw their stimulus. This also, of course, leans down on economic activity via higher borrowing costs and also potentially through adverse wealth effects should we see corrections in asset prices. And those financial market vulnerabilities can take numerous forms. We see very elevated house prices in many economies. We see very elevated financial asset prices, be that equities, be that risk premia in fixed income markets, or also a potential risk from very aggressive Fed policy tightening, leading to capital flows away from emerging markets and into hitherto more attractively remunerated assets as advanced economies, central banks raise their policy rates. Now, I mentioned earlier the fluid state of some of the assumptions which underpin our baseline forecasts. And to reflect this, we also look at alternative scenarios within our global link model. And these scenarios can be affected by a range of outcomes related to the Russia-Ukraine conflict. It could be the duration of the conflict. It could be how it ends, how strictly sanctions are applied and for how long, what happens in practice to trade flows, meaning compliance with the sanctions or even self-sanctioning, which we've seen, identifying alternative suppliers for key products, impacts on confidence, policy responses. All of these things can have an impact in a very different way from our baseline forecasts. Now, we've used the global link model to come up with two alternative scenarios. The first of which here on the left is more negative for growth prospects, the Russia isolation scenario. The second is somewhat more positive. The former, the isolation scenario, effectively assumes a full embargo on Russian trade. It also incorporates some pretty extreme scenarios for energy prices. Brent crude oil on the left in grey, and European natural gas prices on the right, again in grey. So in that scenario, which we don't think is the most likely outcome, but were it to materialise, we would see materially different economic forecasts. The costs to the global economy would be far larger than in our baseline scenario, with virtually no real GDP growth at all during 2022. Now, the fact that the economic cost of such a scenario is so high is one of the reasons why we consider this to be a rather unlikely scenario. Still, it's a tail risk that we need to monitor closely. A tail risk meaning comparatively low probability, but relatively high impact. So in summary, we have revised our forecasts for global growth, inflation, and policy to reflect the shockwaves following Russia's invasion of Ukraine. We accept that there are very high levels of uncertainty surrounding our new baseline forecasts, and we've created alternative scenarios to try and calibrate and estimate what those impacts could be. The bottom line is we have another shock following soon after the COVID shock, and that creates a range of different uncertainties and potential volatilities. Now, given time constraints, I'll bring my section of today's session to a halt at this point. We do, though, I think, have a little time left for questions. So, Christiana, back to you.
Thank you, Ken, for your presentation. Let me please remind everyone, you can use the Q&A tool to ask us questions and hand in your questions that way. Ken, a first question that I have for you: what is the key downside risk to growth that you see?
Thank you. Yeah, it's a very good question. I already alluded to one, which is disruption to energy supply. One of the unusual features, and this is particularly focused on Europe again, of this crisis is that while sanctions have been introduced in a variety of different forms against Russia, we still have the flow of energy from Russia through into Europe. And of course, that's been a source of some discomfort for many governments across Europe. As I mentioned, the sensitivity of Europe's economies, particularly some of the larger ones like Germany and Italy, to gas supply has so far led to a non-uniform approach within the EU to the issue of an embargo on energy imports. And as I said, in our baseline scenario, we assume that most of the impact of the disruption to energy comes through the price channel rather than supply. But if our assumption is incorrect, and either the EU decides to embark on an embargo, including gas from Russia to Europe, that would make a material change to our forecast, particularly for Europe, but also with spillover effects elsewhere. The other thing I would mention, which is not immediate, but which is very relevant to the broader issue of higher inflation, is the possibility that central banks take policy rates into restrictive territory. Again, this is not in our baseline scenario. We assume several rate rises from the Fed this year, a swathe of interest rate rises continuing in emerging markets, and even the European Central Bank, which has been relatively slow to tighten so far, starting its tightening cycle more quickly from later this year. But we assume in all cases that nominal and particularly real interest rates do not become restrictive, that a stitch in time saves nine, effectively, that if central banks act quickly enough, they'll keep inflation expectations in check, and they'll only need to take interest rates back towards more neutral levels. If that's wrong and these inflation pressures are more persistent than we've assumed, then central banks may need to go further. And if they do take policy rates into negative territory at the same time as unwinding their unconventional measures, then that again would lean down more significantly than we've assumed on our global growth forecasts. And monetary policy tightening feeds through to economic activity with a lag somewhere between 12 and 24 months. So that's not for this year, but that's certainly a medium-term challenge as well.
Thank you, Ken. And I think that's it for the moment. I would say if you have any other questions, please reach out to Ken by email. You will find his contact details on his slide. And Ken, thank you again for sharing your insights on the economic side.
Thank you, and good luck with the rest of the sessions.
Thank you. And with that, we move on to the medium and heavy commercial vehicle production. To start us off, I have a poll question for you. So I hope to see some answers for you to this question, which is, which risks will have the biggest impact to truck production in 2022? Is it COVID cases rising, and with that the closure of plants and ports, etc.? Or is it missing input material for chip production, for example, neon gas? Is it rising energy prices, rising material prices, semiconductor shortages, or the missing wiring harnesses from Ukraine? So I give you a couple of more seconds to answer this poll question. And I already see that answers are coming in. So let's have another 10 seconds to complete this. Okay, so let's take a look at the results. And we see here semiconductor shortage, according to your answers, is still the dominant factor on European truck production, closely followed by rising energy prices, rising material prices, and then to a lower extent, missing input material for chip production and the wiring harnesses, and COVID cases rising with the smallest share here on the screen. Thank you very much for your answers to the questions. And we will see what we use for the current forecast as assumptions to it. So first of all, we did this extraordinary update because of the current situation with the invasion of Russia in Ukraine. As mentioned, this is wholly uncertain regarding the outcome and what kind of geopolitical impasse will follow. At the moment, what we took into account also for our assumptions was it's not possible to predict how long President Putin will stay in power. There is the assumption that it's even likely that he stays up to 2036. And in that case, that also sanctions might be in force for the same amount of time. Oil, gas, key raw material prices will continue to be exempted from the targeted sanctions. So that's our working assumption for this forecast. And that also Russia would not, out of its own accord, stop the export of these commodities. On the other hand, Russia-Ukrainian exports on natural gas, oil, neon, metals, grains, fertilizers will be reduced but not stopped throughout the conflict. But this will drive prices further up and disrupting further the global supply chains. And we would see commodity prices peak around mid-2022. And the majority, but not all of the foreign assembly plants in Russia shutter and do not reopen over the forecast period. And the conflict limits Ukrainian-based bus and parts manufacturing, and the export shipments will go significantly down here. So this is one part of our assumptions. If we take a closer look at specifics, we have palladium, and I will mainly kind of go through the base case scenario. You see optimistic, we just have an upside for semiconductors that we do not see at the moment, and an even more pessimistic option. I will concentrate on the base case. So palladium, we see at the moment plenty of supply for now. There's slightly reduced incoming supply of raw material due to the airspace closures. It's more a friction than stop, and risk rises toward the end of this year. The semi-finished goods used in automotive industry, including carbon black and wiring harnesses. So this is a mixed bag. Carbon black, still a lot of supply for the moment. There is a risk, and it will be more visible in the summer. Wiring harnesses is an acute problem for several of the passenger car manufacturer, as well as for one of the European truck producers. Then we see energy deliveries to the European Union, as Ken also mentioned. For the moment, we see this is ongoing. Risk is here that there is a potential that this could be stopped from either side. Foreign brands producing in Russia, this is something all foreign OEMs in the truck sphere have suspended their production at the moment. Some of them might come back, others will be, for at least for the duration of the conflict, not be producing in Russia. There is the chance for increased imports from China to Russia to make good for the volume that is lost from Western European manufacturers. Diesel fuel availability, there is a risk here. Traders have stopped buying Russian diesel, which has left European market very short. And semiconductors, as you also answered in my little poll question, this is where we have a significant impact. What does that mean if we look at global truck production? So this is not Europe, this is global. Here we see about 190,000 units that we have taken out of the forecast compared to our February release. And this means overall that we see a reduction in the global truck output of 10% in 2022 compared with 2021. And we're expecting a 1% increase for 2023 with this new forecast. As it's not only Europe that is affected, but also the other regions, which you can see from this slide. And not all the volume lost can be attributed to the war in Ukraine or the knock-on effects, but also supply shortages and stoppages at individual OEMs play a role here. And before we really move into Europe, let's have a quick look at the global regions and how their growth is 2022 versus 2021. We have Europe, which will go down by 8% and 40,000 units compared to 2021. And we will go into more detail about the reasons here and who's affected, but mainly it will be Eastern Europe. We have China declining by 22%, as mainland China sees easing of fiscal stimulus in the truck sector, and the geopolitical tensions led PPI and oil price inflation to further weigh on industrial production. Also here, production was suspended at FAW in March due to the pandemic lockdown. Then we have Japan and South Korea. Here in 2022, the output is down by 5% due to economic downturn and part supply problems. Also, Hino has suspended production of domestic vehicles from end of March due to emission fraud, which has an impact on sales and production this year. The last region, which is down, which is South America, sees a decrease as semiconductor and tire shortage keeps the production in a stop-and-go mode. The demand side here also takes a hit and influences production. Coming to the green regions that make some gain compared to 2021. We have Middle East and Africa that profits from the higher oil prices and sees an increase of its truck assembly. We have South Asia. The growth here is primarily driven by India, as the OEMs in India have been talking a lot of pent-up demand coming to fruition in the short term. And we have North America with the biggest increase expected this year. Nonetheless, also here we see supply shortages, but they are expected to ease over the course of the year, and very full order books for trucks that should come to an effect and lead to an increase of 43,000 units compared to 2021. And with that, we move really into Europe and take a look at the map of Russia and Ukraine. You see here the different plans that we have that we are tracking across both countries. Red indicates a production that was suspended. Green are the manufacturers that are still producing. So all foreign OEMs suspended their operations and production plans in Russia. Main reasons for this are sanctions imposed by various countries, and therefore the missing parts for the assembly, but also the shutdown because of not wanting to be involved in the whole thing. Also, the missing parts will also affect the domestic manufacturers, and several products will be stopped when the supply run dry for some time. Before the local sourcing can be built up. Truck production in Ukraine stopped already in 2020, but there are two bus manufacturers that you see on this map that we also put to zero in our forecast. When we look at the manufacturers, the domestic manufacturers in Russia, plus we also included Mars on the slide here, who are producing in Belarus, but are having a high export share to Russia and serving the market there. You see, we have significantly decreased the volume for those manufacturers this year compared to last year. And several of them are facing severe sanctions. So their gas group, for example, was already under sanctions since 2018. We expect here significantly lower volume. And also the export to non-CIS countries is expected to decline or to stop even. Electric city buses will also be limited because of parts availability, as most of those are supplied by Western suppliers, especially the electric drivetrain. For KAMAZ, we also see a significant downturn. The parts supply from Daimler Trucks has stopped. We see here that the K4 platform, which is based on the Mercedes-Benz Axos, will end in 2022. The K5 platform, which is the current one, the most modern one that they have, will be idled from May, and also the volume for April will be very small. And they're working here on new suppliers and expecting to restart this production line in 2023, although with lower output. And of course, that means there is a higher share of the older K3 platform, which has no Mercedes-Benz technology in it. And then there might also be the chance to provide lower emission levels. This is something which is at the moment discussed if the Russian government will relax some of their emission legislation. Also, Kamaz is involved in a lot of electric bus manufacturing, especially for Moscow. And also this will be reduced and even stopped as soon as the electric drivetrains run dry that came from Western Europe. And also here we do not expect exports to countries outside of CIS. Ural, very similarly, low volume expected. Also here the chance to move to lower emission level trucks. Mars, as said, is the manufacturer in Belarus. Big exports from Belarus to Russia. It's their main market. And Mars has already been under sanctions since summer of 2021, which influences also their ability to get parts from Western Europe. If we look at the other European OEMs, there we see the picture that there is more impact from the chip constraints and chip shortages, especially to mention here recently, Iveco had to go back to a lower line rate at the end of March, and also closing last week, additionally to what they plan to close over the Easter period due to a lack of semiconductors. We also see at Mercedes-Benz that the engine plant production in Germany was suspended in March, transmission plant suspended in April, which will lead to lower line rates in the truck assembly. And we also see MAN being the OEM mainly impacted by the missing wire harnesses from Ukraine, and which has to completely stop production for several weeks. Already in March, there were more stoppage days than there were production days. And it's not yet clear how long the situation will continue, but it has a significant impact on the MAN production. MAN offered its customers to cancel their orders because the delivery times are significantly increased to the level that they already were before that because of the chip constraint. And they offer their clients to order with new conditions, new delivery times now. Some of the other OEMs still feel and see the chip constraints, but at the moment, no stoppages are announced. Some also have stable line rates and even increased their output recently. What does that mean for the overall production in Europe without Russia? So you see here, compared to the last forecast, we took 11,000 units out of the forecast, and the overall production sorry, will decrease 1% in 2022 compared to 2021, and for 2023 we now see a 5% increase. Negative items and positive items you can see on the slides, just to highlight some of them. As you also mentioned in my poll, increasing material prices, is one item that we see here. We see a substantial order book, so that keeps production up and running, and the OEMs will be able to sell everything that they can produce this year. It's more still like last year, constrained on what can be produced. But also some OEMs already returned to kind of stable and improving line rates, so that seems to be a good sign here. If we turn to Russia, the picture is significantly worse. We have taken out 38,000 vehicles from the forecast. And this means a decrease of 46% in 2022 compared to 2021. And a further decrease of 7% is expected even for next year. And the decrease unfolds as production of Western European manufacturers and also other manufacturers stopped, also all the foreigners. If we combine Ford, Hyundai, Iveco, Isuzu, MAN, Mercedes-Benz, Scania, and Volvo, last year they made up for a volume of 16,000 units. This year there was the expectation they would build they would build 17,000 units, so that was already a significant part. We also see, as mentioned, that Western and Asian sanctions lead to a shortage of parts that are not delivered anymore to Russia. And that means Russian manufacturers have to suspend or significantly scale down the production of modern trucks. We also see that it's not only the sanctions that stop the import of parts into Russia, it's also that joint venture suppliers have stopped operations in Russia, and also this drives the parts unavailability in Russia. On the other hand, the export markets that Russia can reach for its products also now declines and will mainly focus on the CIS. And demand is expected to take a significant hit, but Renata hopefully will tell us a little bit more on this side. On the positive side, or upside risks, you could say, for especially for next year, is that the manufacturers might find alternative suppliers for their more modern trucks and can then restart production of those. And there is the chance of lowering emission standards by the government to counteract the parts shortage and to keep up the supply in Russia with trucks. Before we move on to my last slide, we will move on to buses now. And I have another poll question for you, which is, which factors will drive the bus production in 2022? Is it the European Clean Vehicle Directive? Is it fleet renewal? Is it increased commuting because we're returning to office? Is it subsidies for electric buses? Or is tourism and the opening of European travel destinations a boost for the bus production in 2022? So I'm interested in seeing your answers. So you have another 10 seconds to answer to this poll. I already see answers coming in, so use the last seconds that we have here before I will show you the results. Okay, so these are the results. So a lot of you, or half of you, think the European Clean Vehicle Directive and also the subsidy for electric buses are the major drivers of the bus production this year. Increased commuting and tourism and reopening of travel destinations, like 25%, and fleet renewal, the lowest here. So let's turn to our forecast for the bus production. Also here, the same split. So we have European bus production without Russia, and on the right side, then just Russian production. We have split here the production into city applications. So that means 10 to 15 meters city buses plus the articulated 18 to 24 meter buses, which represents the highest part of the market in Europe. And also the coach and intercity bus production we see going up here. So both those segments. To a lower extent, the production contains mini and other buses, as especially in Central and Western Europe, mini buses do not play a big role. And also here, a slight increase is expected for 2022. In Russia, on the other hand, you can see we see a significant downturn also for the bus production, also driven from the demand side. Here, the segments are a bit different. So mini and other buses have a much higher share and also take the biggest hit. And with that, I thank you for your attention and hand it over to my colleague Renata to walk us through the demand side. Renata, the floor is yours.
Thanks, Christiana, and hello, everyone. I would like to start my presentation with a quick overview how demand for new trucks improved in Europe in 2021. As you can see from the graphs on this slide, demand in Europe turned it into a positive trend in 2021 compared to what we saw back in 2020, especially in Central European countries. In Central European countries, all Central European countries registered a double-digit growth year on year in 2021, with Baltic state countries and Poland gaining the largest growth. In the short term, freight companies will face some headwinds associated with higher fuel prices, shortages of drivers, and rising cost of trucks, as the current semiconductor crisis, as well as high prices of raw materials, lead to truck prices increases. The sector is also facing additional challenges owing to the European Commission mobility package. Among other regulations, the package demands that trucks should regularly return to their country of registration, and that decreasing the flexibility for businesses. In addition, companies will have to comply with new regulations such as CO2 targets, clean zones, and safety regulations, which will also elevate the total operating costs. If you look at the Western European countries, sale of heavy commercial vehicles rose by 25% year on year in the first half of 2021, but then the situation changed into negative direction, and overall Western Europe finished the year with 11.6% growth. If we look at the Eastern European countries, the Russian market dominates in Eastern Europe, and accounting around 70% of the region's sales in recent year, and much depends on its overall direction. Last year, much of the region benefited from the recovery in global crude oil price and demand from commodities, which boosted exports revenue. the role of vaccination program in the region is much slower than in the rest of Europe. This was evident in the fourth quarter of 2021, and when Russia was forced to introduce another lockdown, which took toll on local businesses. Now, if we look what is actually our presumption for this year and how we changed our April release forecast compared to what we published back in the first quarter. The supply chain disruptions forcing by Russian invasion on Ukraine and will continue to affect sales of heavy commercial vehicles in Europe in 2022. This lockdown was already evident in Western Europe from last quarter of 2021, and Central Europe countries also beginning to trend down as well. The crisis with components is expected to intensify as an outcome of current crisis, especially as Ukraine is a major hub in Europe for many component suppliers, and this will put lots of pressure on the European truck OEMs. The soaring energy prices and raw material prices will translate into higher truck prices. In addition, logistic companies will be hit with high operating costs driven by rising inflation and surging fuel prices, and as well as missing drivers who may have been from one or another country. As you can see from the graph, we have lowered our forecast for heavy commercial vehicles demand in Europe in the short term in our latest release, and we expect what the heavy commercial vehicle market won't see any relief till the end of 2023. If we look at the how it's actually represented by the regions, it's like Western Europe. We predict that Western Europe will go down by around, like our prediction, going down by 5%, whilst in Central Europe we see 8% difference compared with what we published in first quarter. And the biggest impact is actually in Eastern Europe, as I mentioned before, because it's dominated by the Russian market. And in the Russian market on its own, it's have also undergo significant disruption, and the economical sanctions regime imposed by European Union and UK are the most severe but has been ever imposed, and a number of global OEMs have already completely halted their export to Russia. It is also goes without saying what the Ukrainian heavy commercial vehicle market is said to be decimated by the conflict. The Russian invasion on Ukraine is an unfolding human tragedy, and it is already having a grave impact on the global economy. And all this leads us to rising oil and gas prices and other living costs as well. If we turn over to see how it's actually, we see the representing of and the branch share. Overall, like when we compare to like 2021 and 2022, we can't see like significant changes. It's only a couple of cents up and down, but overall, as the Western and Central Europe, they will be dominated by the European OEMs, whilst Russia will be dominated by local producers. And there have been like a lot of announcements, but even the manufacturers, they are stopping their production, and it could be some problems with selling their trucks, and because it won't be delivered at time, we still, as it's all the OEMs, they're facing the same problem. We can't say there's significant changes for one or another brand, like if we look at the share position. If now let's see how actually the situation is changed on the country level. We expect that Ukraine-Russia war will have significant impact on the heavy commercial vehicles market in Europe in 2022, and as well as continuous supply chain disruption. And this will impact deliveries of new trucks. And some, like not some, but most of the logistic companies, they will suffer from high operational costs, and some even maybe smaller logistic companies, they will be forced to shut down, especially that will come in Eastern European countries and small Central European countries. If you look at some countries, bigger countries in Europe, like Germany, we have lowered out our forecast for 2022 and then 2023. And this is because it will have a lot of impact from the conflict on the country, and because the outlook for manufacturing sector has deteriorated sharply with the onset on the war, as many supply chains are disrupted. We still predict what demand for trucks will start to pick up in second half of the year, but it won't be a big growth, even though it will be like maybe somehow like less than 1%. And the material shortages and rising input costs are becoming a major problem for many companies in the country. And it could be, it will even turn into the worst situation if Germany determined to import the gas from Russia entirely, and the Germany is likely to remain a affordable business and environmental destination from the current administrative term. However, the government response to Russian invasion of Ukraine in US as well as Russian countermeasures will affect businesses of all sizes in Germany. If you look at Italy, in our April release, demand for new trucks in Italy revised downwards by less than 1% compared to our Q1 release, when we had already lowered up our prediction in that release because of semiconductor problem. And after this solid growth in 2021, we expect what the demand in Italy will go down by around 3.7% year on year. And weaker near-term growth outlook is likely due to drag from Russian invasion as well. The conflict has resulted in even higher energy and food prices, causing more elevated inflation in Italy. And the conflict will also likely to hit investment spending in the country, with firms facing continuous supply chain disruption and uncertain demand both at home and from key export markets in Italy. We expect what economy in Italy will contract by around 0.3% quarter on quarter in second quarter of 2022. Sorry. If you look at the main Central European country, it will be I will choose Poland, as it's have the Poland, they have direct trade links with Russia, Ukraine, and Belarus, and all these conflicts really have significant negative sides on the country, as it's all three countries combined taking about 5.6% of the total export in 2022. And given that Poland borders on all three of these countries, it is unsurprising what the confidence in the transport sector has fallen, especially sharply. Given the fact that many truck operators are very active in Eastern Europe, we expect that loss of businesses will be significant due to Russia-Ukraine war. In Poland, the household consumption and fixed investment are projected to weaken during the coming months. In 2021, Poland truck markets have already reached decreased level, but demand has slowed down significantly this year. In April release, we have cut our prediction by 10% for 2022 forecast, and addition 8% in 2023. This is like compared to our first quarterly release. And similar to the rest of the Europe, Poland will be hit with truck shortages as due to the semiconductors and other component crisis, as well as high operating costs, high fuel prices, high inflation, and rising truck prices. This another big issue is again is a driver shortages in the country. Now let's have a look quickly at some countries of its own, and I will start with Russia. As the consequences of the invasion of Ukraine, Russia is facing steepest recession since 1990. According to March macro outlook, the real GDP is expecting to contract 11.1% in 2022 and an additional 3.7% in 2023. In the answer of the Russian invasion of Ukraine, the Western countries have introduced a wave of sanctions on Russia, among them ban on transaction, SWIFT use of VTB bank, ban on purchase of Russian debt. Germany suspended the certification of USD 11 billion worth of Nord Stream 2 gas pipes from Russia. VDI ban of 13 Russian energy companies, EU import ban on Russian steel products, then restriction of export and advanced technologies, including semiconductors. In early March, the Russian ruble plummeted to all-time low as it lost 50% of its value. And in 2021, demand for trucks in Russia rose by 34% year on year and finished the year with around 98,000 units. The later data suggests that the market rose by 12% in first quarter of 2022. However, sales in March were 8% lower. In our April forecast, we have cut the outlook for truck by around 50% compared to our first quarter assumptions. With the deep recession, high inflation, and high borrowing costs, private and business consumption is expected to be very low in Russia, and ruble is expected to be weak for the long term. And unemployment will double, and supply side shortages will keep inflation elevated for at least 2 years. We expect that many truck operators, especially small and medium enterprise, may not be able to survive this crisis. And with the companies that will be able to get through, it will be big problems with purchasing trucks. As the local truck OEMs, they will have to cut back on production due to shortages of European components. The Russian government has temporarily allowed to produce and sell Euro 2 vehicles, and Russia has currently Euro 5 norms. As the local truck manufacturers rely heavily on the foreign components to produce modern trucks, they are forced to come to this decision. And most of the foreign truck OEMs stopped truck deliveries to Russia, as well as froze their production activities in early March, as Christian mentioned during her presentation. We currently assuming what Western OEMs will not go back to produce their trucks in Russia, and there's a big chance that companies will rely on either local brands or Chinese brands. We do not expect the Russian truck market to go back to the previous sales of levels during the forecast horizon. If you look at the UK, in our April release, we have lowered our outlook for heavy commercial vehicle sales in short-term terms compared to first quarter forecast, as the economic outlook has worsened. Growth resumes in we predict that growth will resume in second half of 2022, but we anticipate a very limited rebound because of the persistently elevated inflation due to the prospect of high energy prices for longer, as well as supply disruption and also confidence effect for Ukraine conflict. We've got bright outlook for business investment underpinned by temporary tax breaks, and the Brexit resolution is the main risk for the short and medium term UK forecast is centered on the split over from the Ukraine conflict alongside with legacy impact on the economy from COVID-19 crisis, and also the government strategy to contain the outbreak. The second risk for the UK is the limited EU and UK trade deals, and this is namely that large part of the UK economy belong to the scope of this agreement, and it is future relationship with EU for much of its UK and economy and the financial services sector remains unclear. As a result, demand for trucks driven by home delivery sectors and construction sector, as well as high truck prices and driver shortages. The replacement demand will be driven by sales of trucks going forward due to thought measures toward the clean vehicles. And UK plans to ban sales of new petrol and diesel heavy goods vehicles by 2040. At this point, I'm turning to Turkey, and the fallout from the Russian invasion of Ukraine is already high inflationary pressure and is currently the most immediate concern for businesses with Turkish exposure. This includes supply chain disruption resulting in food shortages, soaring gas prices, increasing operating costs, and the potential for export control and limited foreign currency control to stem significant lira deterioration. After moderating in early 2022, and the invasion once again triggered lira losses, with Turkish currency depreciation since that time surpassing all the other major emerging market currencies except the ruble. And loss of export and high energy costs, what will underpin domestic demand, will result in significantly lower economic growth that assumed pre-invasion. As a result, we have lowered out our sales forecast in the country by 2.2% compared to our first quarter to 2022 release. And we also think the Russian invasion of Ukraine has brought considerably new uncertainty to the country, and with dramatically low outlook on fixed capital investment. Even though demand for new trucks in Turkey started to pick up and recorded a solid recovery back in 2020 and then continuously in 2021, demand for new trucks will go down we predict will go down by around 1% in 2022 due to supply bottlenecks and soaring energy prices. Overall, the total sales figure will remain relatively low and needs more years of growth to return to the previous highest level of sales of new trucks in Turkey. And at this slide, I would like to cover up this bus sales in Central and Western Europe. As you see on this on this slide, the bus market in Central Europe is relatively small, and I would like to state what the Poland is the largest market with around 30% of the region buses sell, whilst Western European bus market usually accelerates at about 22,000, 25,000 units per year. On average, 50% of bus sales in Western Europe are city buses, and it is in the last few years the segment has been expanding at the fast pace. This is due to growing trend to replace old vehicles with alternatively fueled buses, and owing to the EU funds and clear zone regulation presented in the most large cities in Europe, demand for alternatively fueled buses have been growing fast among municipal operators. Some cities have already announced that they will stop buying diesel buses, such as like London, and other pledged to buy only zero-emission buses from around 2025. This was stated by, for example, Paris and Madrid in Spain. Bus operators suffered immense losses owing to the impact of COVID-19 pandemic on public transport in Europe in 2021. And this was led by travel bans and individual concerns severely reduced travel and transport demand. Coach companies experienced the greatest impact with their new revenues down and the bleak outlook as lockdowns and restrictions were introduced across Europe. Given the uncertainties related to the COVID pandemic, demand for buses was muted back in 2021. And going forward, sales of buses will get a boost from the targets set by European Commission, and as at least one quarter of new buses purchased by public authorities in Europe, in European city, will have to be climate friendly by 2025, and at least 1/3 by 2030. Coaches are expected to excluded from this regulation, although individual countries have started to introduce initiatives and discounts for purchasing coaches, which should encourage replacement demand in this segment. At this point, I would like to conclude my presentation and turn over to my colleague, Chris.
Thank you, Renata, for your presentation. And thank you all for listening and handing in questions. We have already answered a couple of them in individual chats, a couple of ones that I would like to pick up. We got a question regarding the slide that I showed regarding the base case and optimistic and pessimistic. So we had the base case at like 50 to 60% probability. I would assign 5 to 10% to the optimistic scenario and 30 to 45% to the pessimistic scenario. Also, we can say that kind of the pressure on the semiconductor shortage will remain high with the current port closures in Shanghai, which has a big impact on European manufacturers as well as manufacturers around the world. Then I think I had, and also we got the question regarding, is there also a trend for more semiconductors in trucks, as you also see this trend on the light vehicle side? Yes, we see that as well. Also here, the newer the trucks get, more electronics and things, the higher the amount of semiconductors that are in. If you have any further questions, please send us an email to Renata and me, and we will answer your questions by email. I would also like to invite you to our next webinar in this series, which will be Connected Car Data and OTA Strategies, which will happen on the 31st of May. So just scan the QR code that you can see on the screen to register, or use the link that you should see in the audience console. Besides that, I would also like to invite you to the extraordinary global medium and heavy commercial webcast that we are providing later today in less than 5 hours. We will repeat some of the content and points made in this forecast, but we will also touch on more global impacts in other regions. So you're very welcome to join us there as well. Otherwise, I just can say thank you for your questions. Thank you for your attention, and hope to see you soon again. And with that, goodbye.